Hey everyone, welcome to our Wednesday afternoon workshop, Wednesdays at 1. Thank you all for joining. We're going to give another minute, let people jump on, and then we're going to go ahead and get started. All right, so today's a little bit of a different topic than we normally cover. We actually haven't even covered this topic, so this is brand new for everyone. We're going to talk about crowdfunding. Many self-directed IRA investors don't realize that they can use their self-directed IRAs and invest in things like startup companies. There's a lot of angel investors out there, and there's a lot of websites that you can go to find these types of investments. So it's just like a private equity purchase or private stock. Anything like that would fall under this category. So Sam, our guest, is going to cover a lot of information on that, some due diligence steps, and good resources for you. So first off, we're going to start with what's a self-directed IRA. So anyone new out there that's not familiar with self-directed IRAs, a self-directed IRA is just like any other IRA. The only difference is companies like Fidelity, Charles Schwab, Merrill Lynch, they limit you to the stock market, stocks, bonds, mutual funds. And that's great if you want to invest in those types of investments. But if you're looking to diversify your portfolio into what's called alternative assets, then a true self-directed IRA, you need a self-directed IRA custodian. This allows you to invest in other types of assets, and it is self-directed. You choose those investments. So you get the true diversification into alternative assets like real estate, private lending, mortgage notes, tax liens, cryptocurrency, startup companies. So a lot more things out there that you can invest in. You get the tax savings that comes along with it. It's going to be tax deferred or tax free. It just depends what type of vehicle you want to use. And you're investing in things that you might already be doing. You might be the expert when it comes to real estate investing. You might have investment properties already, but you didn't know you can do it in an IRA. But you can. So self-directed IRAs have been around since the 1970s. If you want to learn more, you can always reach out to myself or someone on my team. We can reach us at IRA specialist at NuViewTrust.com. So these are some of the most common plans that clients use to invest in these alts. The first two are personal plans, most common, traditional IRAs and Roth IRAs. Typically, a traditional IRA is pre-taxed, where the money is coming from, if you ever left an employer and you had like a 401k, a 403b, a TSP, anything like that, and you did a rollover to an IRA, it would typically go into a traditional IRA if it's pre-tax dollars. But if there's any post-tax money in there, it would go into a Roth IRA. So that's why these are the most common types of IRAs clients usually have. There are contribution limits to these plans. If you're under the age of 50, you can contribute $6,000 a year. And if you're over the age of 50, you can contribute an additional $1,000 to each one of those plans. The Roth does have income limits. So if you make, and your spouse, if you're married, make $208,000 or more a year, then you probably can't directly contribute to the Roth IRA. But you can contribute to a traditional IRA. If you really wanted it to be post-tax dollars, you can do what's called a Roth conversion. So they're just taxed differently. The traditional IRA is going to grow tax deferred, which means you don't pay taxes on that until you start taking distributions after you're 59 and a half years old, and it's taxed at whatever your tax bracket is at the time, versus a Roth IRA. You're going to pay the taxes on either the Roth conversion or the contributions now, and then it's going to grow for you tax exempt. And when you take those funds out of the Roth IRA after you're 59 and a half years old, there's no penalty, and it's going to be tax-free. So that's the biggest difference between the traditional and the Roth IRA. Always discuss with your CPA which one works better for you and any investments that you make prior. Then you also have your employer plans like a solo 401k, SEP IRA, and a simple IRA. These have higher contribution limits because they're employer plans. A solo 401k allows you to contribute up to $61,000 if you're under the age of 50. If you're over the age of 50, there is a catch-up contribution of another $6,500. So a big chunk of change you can contribute. A lot of people that are eligible for this love this plan because it has some other perks that come along with it. If you invest into anything that has any type of leverage involved or mortgage, it's exempt from the UDFI tax. You can also take a loan against a 401k plan up to $50,000. Just cannot be more than 50% of the total value of the 401k plan. You can also diversify between your traditional assets like stocks, bonds, and mutual funds, or your alternative assets. So that's why a lot of people are fans of the solo 401k plan. You do need to be self-employed with no employees in order to be eligible for the solo 401k. Then you have your SEP IRA. The SEP IRA also up to $61,000 you can contribute a year. There is no catch-up contribution with that one. This is good for people that are self-employed as well. You do need to be self-employed, and you could have employees. However, there's a mandatory match. So if you contribute up, which is the max, up to 25% of your income to be contributed to the SEP IRA, you have to do the same for your employees. 25% of their income needs to be matched to their SEP IRAs if they're eligible. And then you have your simple IRA, great for small businesses, $14,000. You can contribute a year to that plan. Catch-up contribution if you're over the age of 50 of $3,000. And there's a 3% mandatory match for all eligible employees. These other plans are specialty plans. You have an education savings account and a health savings account. Most people don't know that these can be invested. So a health savings account is just like it sounds, it's for medical expenses. However, you can still invest that and partner it with the other plans like a traditional IRA or one of the employer plans on your investments and keep it growing for you, accumulate your medical expenses and cash those out later. So it goes in tax deductible and it comes out tax exempt. So that's pretty cool with this health savings account that you can do that. The contribution limits for, if it's just you covered in the plan, it's $3,650. If it's a family plan, it's $7,300. There's a $1,000 catch-up contribution, but you have to be 55 or older to make that extra $1,000 contribution. And then your education savings account is great for your kids, grandkids, anyone that you're saving for college for. You can only make contributions until they're 18 years old. It's only $2,000 a year, but if you partner that with some of the other investments and the other accounts that you have, that's how you can keep that growing as well. So those are the plans that are eligible to be self-directed. And these are the most common investments you see. Private entities, anything like limited partnerships, LLCs, joint ventures, trusts, real estate, your foreclosures, tax liens, apartments, self-storage, mobile home parks. You can even invest in offshore real estate, your cryptocurrencies, and your promissory notes. So secured or unsecured notes. You can even create your own note if you like. So with that, I'm really happy to bring on Sam. We connected actually via LinkedIn. When I saw his profile, I was very interested in his experience. He is a 14-year investment banker turned serial entrepreneur. And now he's the CEO and co-founder of ArkHAUS. He graduated from UCLA with dual degrees in 2001. He joined Bear Stearns market-leading mortgage analytics FAST group. And by 2006, he was already running Royal Bank of Scotland's ABS and structuring team before launching his fintech mortgage startup. So he's got a lot of great experience in the crowdfunding area. And I think you're going to learn a lot today. I'm really excited to bring him on. Sam, you there?
I am here indeed, and I'm getting my video on. Can you see me?
All right, Sam, how's the weather in New York?
It's pretty good. It's better than yesterday. Yesterday was brutal.
Awesome. So I'm going to let you go ahead and take over from here. I'm going to rejoin you at the end. I'm going to read the questions for Q&A. Anyone listening, if you do have questions, type them in the Q&A section. I'll read those off to Sam, and then we'll take it from there.
Hi, everybody. My name is Sam Payrovi. I am the co-founder and CEO of ArkHAUS. So today we've been invited to come speak with you guys about how equity crowdfunding and self-directed IRAs kind of create this magical world where you can gain access to early stage startup investing, minimize your risk, and increase your opportunities through diversification. So first, just gonna tell you a little bit of it more myself. Brian already kind of did a pretty nice job. Spent 14 years in investment banking at Bear Stearns and Royal Bank of Scotland, and then Mesro. I was an analytics and structurer involved in some trading and sales, primarily debt securities, so mortgage-backed, asset-backed, anything debt-related. Got into a lot of the crazy stuff, so understand that world really well. And then I went into kind of an entrepreneurial journey somewhere around 2009. Went back into finance, and then 2015, I went full on into the startup world. Our company has actually had a couple of different iterations, and we recently created this concept called ArkHAUS, which is a floating private membership club that is coming to Miami in 2023. So some of you might be familiar with Soho House or some of the other private members clubs. Just imagine if that was floating on water, and that's basically what it is. So it sounds crazy and phantasmical, but the reality is there is one of these boats already in existence in Miami, and we are working with that manufacturer, who is called ArkHAUS, to create 4 of these boats that are smaller. We just connect them in a square configuration like you can see on the right hand side, and then we make it a membership club. where members pay annual dues and they have access to come on board with their guests, friends, and family, food and beverage available on board. It's really an experience that doesn't exist anywhere. And our goal is to whip out 7 of these over the next 5 years and really compete with ArkHAUS and maybe become an acquisition target. So, but today we're really here to talk about crowdfunding. So, crowdfunding has existed in many forms, but crowdfunding as an investment or equity crowdfunding really wasn't created until 2012. Before that, and I'll speak a lot about how a company views this because that's the angle I come about it. And at the end, we'll talk about what it really looks like as an investor. Before the Jobs Act in 2012, the way a startup funded themselves primarily was going to their friends and family, going to VCs and angels, and pretty much the only people who could invest in these companies effectively were, people who were very well-heeled, accredited, and top 2% of income earners. So 98% of the public was pretty much shut out from early stage investing. So it was a very unlevel playing field. The Jobs Act of 2012 authorized regulation crowdfunding, or Reg CF. Basically what it meant is that companies could now actually work through these SEC approved intermediaries and raise money from actual investors, whether it's $200, $1,000, or $50,000, and raise their deal in a much different way and give a lot more access. So companies got access to a much larger investor base and a much broader investor base that cared about their product. But also these investors got access to these companies in this whole sector that they've never had access to before. A lot of these small check investors, less than $25,000 or $50,000. So in effect, Reg CF really leveled the playing field for both sides, for the companies and the investors. So I just want to draw a distinction here on the 2 different types of crowdfunding. The first is product crowdfunding. And this is what most people think crowdfunding is. So on Kickstarter and Indiegogo, you can actually go there and you might be able to buy a new pair of shoes before it's done. So it's pre-purchase or pre-sales of a product that has not yet been commercialized yet. And that's not what we're talking about today. Today, we're actually talking about equity crowdfunding. So that is the opportunity for an investor to invest in a company for equity, or sometimes it can be debt or other types of securities that are similar to equity, but primarily you're investing rather than purchasing product. The 4 biggest platforms where that happens right now are WeFunder, Republic, Seed Invest, Start Engine, and then there's more. There's Our Crowd, Rialto Markets, and I'll mention a couple of these as we go on. There's a little bit of a merger here between these 2 worlds, and that is that on the equity crowdfunding side, a lot of these companies are consumer facing and they have a product that you as a customer could purchase. And clearly they're early stage, so they haven't commercialized that product yet. What they will do is say, if you invest X, Y, or Z, we will give you these perks. So on top of getting equity in exchange for your cash, they might give you a t-shirt or a bowl or whatever it is that they're selling or creating. So, but that's just kind of like a secondary gift. It's really the equity that you're after. So why do companies raise via crowdfunding? Like I mentioned, the traditional raise method is very tough. Going through your own contacts to identify who has the means and is interested, and then educating them to say, this is how I'm doing my raise, please give me $25,000, $50,000, is a massive, massive amount of work for a bunch of very small checks. And then VC and angel outreach is extremely time consuming. So while every VC will tell you, we are out there looking for deal flow and finding companies, they will also hide behind a wall and say, you have to find a creative way to get to me. Find a friend that knows me on LinkedIn, talk to him, get to me. And when you think about the fact that a founder gets 99 no's for every 1 yes he gets, that's a tremendous amount of work to go capitalize a company when you really should be focused on building the company and getting traction. And so basically crowdfunding opened a lot of doors. First and foremost, consumer-facing companies have a customer base they can tap into. So if I had a bar and I was trying to open up a second bar, I could tap into my email list and say, do you guys want to invest in my next bar? Or if I had a product I was selling, I could reach out to my email list or my social media list. So consumer facing companies do very well on crowdfunding, not only because they can tap into their investors, but because once people do become investors, they now say, I not only go to that bar, but I also have an equity stake in it. And they're going to take their friends there. They're going to talk about it on social, and they're going to do everything they can to drum it up. So in effect, you are evangelizing your investors to become vocal advocates for what you have built or are building. And then there's another aspect why companies really work via crowdfunding. You effectively double dip as marketing. So if I'm raising a company or building a company, ArkHAUS, for example, and I know that I'm going to spend 100,000 on marketing to my customers and 100,000 on marketing to potential investors to raise my investor round, well, I might not need to spend that whole 200,000 because everything bubbles up on the internet and social media. So you might only have to spend 100,000 total or maybe 150,000 total to get both of those pieces done. Because a lot of your investors will recognize you as a customer, a lot of customers will recognize your investment offering, and some people will jump in both. And that's the double dip or that happens when it's done right. So there's quite a few different types of crowdfunding. And first, I want to draw a distinction between a private raise. So historically, the raises that startups have done are private or Regulation D raises. Now, there are two different types of crowdfunding raises, and even within those, there's two different types. So the first is Reg CF, which is regulation crowdfunding. This kind of mimics a seed round deal or a very early stage company. And what Reg CF has done is there's two different types. So if you're raising a small round, you are limited to 1.07 million. And the question is, well, why 0.07? And I've heard a lot of myths about why that is, but I can very clearly tell you that 0.07 effectively represents as a crowdfunding platform takes a fee, and $70,000 would be a lot to pay a broker if you're only doing $1 million raise. So they let you raise that additional. It's a pretty low bar on the financials that are required to do a Reg CF raise. You have to have an accountant basically do gap compiled financials. If you want to step up and go up to the 5 million, you can do that still under Reg CF, but your financials have to be audited. Now, what a lot of companies will do is they'll say, let's get going on the Reg CF, the first version. And once we raise $500,000 or 750K, we will then be able to take some funds out and fund the audited financials and then be able to expand up to about 5 million. Because there's really no point in doing that unless you see that you're going to get to your 1.07 million and exceed it. So once you start getting close, then you'll do that as a company. And so Reg CF is really like your early stage seed round type funding. Your Reg A plus, and this used to be called Reg A, and then it was called Reg A plus when they made some changes to how it worked, is also broken up into two tiers. A company can raise up to $20 million. They have to have audited financials and they have to be SEC reviewed, or they can opt to go up to 75 million and again, audited financials and SEC review. Now, the primary difference there is what the company does. So in tier one, you have to file your offering in all 50 states. In tier two, you can do it only in the states that you decide to pursue. Whether some investors may say, I only care about 5-6 states. I think this is going to be my bread and butter. So they're not going to waste the money to do the filing in the other 45 states. So what actually happens is most companies will opt for tier two because there is some savings there. Now, one nuance, and you will see this happen a lot, is a company can offer concurrent private and crowdfunding raises. So my company, ArkHAUS, is currently doing this. And what that really means is I can say I'm going to raise, let's say, $1.5 million total. And I'm going to do a portion of it via regulation crowdfunding, and I'm going to do a portion of it via private raise. And this is exactly what we did. So we said we will raise up to the 1.07 million on crowdfunding, and then we will raise up to 1.5 million on private through angel investors, VCs, family offices. And what that really lets me do is just see where does the money come in faster, right? If I had 2 investors who wanted to put in $1 million on the private raise and that limited the crowdfunding to 500, great, right? it's all about accelerating the raise so you can close out the round and go build your business. So you will see that happen in a lot of places, and it's really important to be aware of that happening because there's there's two primary things. One of them is the rounds, your private and your crowdfunding round, have to be materially matched. Doesn't mean every single detail has to be absolutely perfect, and it's almost very hard to do that with the crowdfunding or private raise, but valuation and the primary terms have to be matched. The second piece of it is that you want to know exactly what's happening and you want to know where each round stands. So if somebody says, hey, I'm running a crowdfunding round, give me $500, you should know exactly where they stand in their private round as well. Okay, moving on. So sectors, where are people very active in crowdfunding? So you'll see that there's this 33% miscellaneous area. And honestly, we can't really speak for that because we don't know what's in that. But the primary offering that you will see on crowdfunding is in food and beverage. You'll see a lot of restaurants, a lot of bars. You'll see a lot of consumer packaged goods like health snacks and candies and a variety of things like that. Why? Historically, food and beverage has been viewed as a non-scalable business by VC. So VC basically doesn't serve it, and these guys move over to crowdfunding, and they've found a huge amount of success there for two reasons. Again, one is that their existing customers become their investors, and then their investors evangelize their businesses online and in the real world, and it really helps grow their business. So if that's the case, well, then why is technology number two? This is a speed concept. Technology is finding that you can work through the VC and angel route, or you can come over to crowdfunding. And if your offering is great, you should be able to raise your money really fast. And maybe you raise a portion of your round via crowdfunding and then turn around and say, okay, well, now we have X amount of traction and you've created FOMO for these VCs and they pile on and they close your round quickly. And again, that's kind of the path that we are approaching. Real estate, one of the really interesting pieces of it, you have a lot of companies that are investing in real estate using crowdfunding. You as an investor effectively become a fractional owner. The same way you become a fractional owner of my company as ArkHAUS or some other company, you become a fractional owner of real estate. And that's why that's really growing there. Green and blue tech, so any type of ESG investing. Again, venture capital has historically looked at this and said, this is not an economic concern, it's more of a social concern. And it's been less about dollars, so they haven't piled in there yet. We now have a lot of ESG funds coming in to fund green and blue tech, but these companies have realized that crowdfunding, where people do have an interest in their products and the promise of what they're trying to bring to the world, it's an easy way and a quick way for them to raise money to go fulfill that promise. Now, you as an investor, if you get into crowdfunding, you should basically find the sectors that, one, you either care about or you have expertise in. And that's where you really should jump in. And we'll talk about that a little bit later. So when people do invest, where do they invest? What are the structures that these companies are using? Historically, most startups have been using convertible notes. And that was what companies would do from a Reg D raise, a private raise. And the first equity crowdfunding platforms actually did the same exact thing. They said, let's use convertible notes. And then Y Combinator came out and said, we're going to create the safe note. And when the safe note came in, it became the preferred method of how companies were investing, not only in the real world, but also in private rounds, but also in crowdfunding. So what we've seen happen over time is that convertible notes have been kind of fading away, and safe notes have become more prevalent on crowdfunding. And that really happens for the very earlier stage deals, your seed and your pre-seed deals.
Hey, Sam.
Yes.
We're having some trouble hearing you.
Is it hard?
Yeah, if you can put the mic maybe closer.
Let me switch to these headphones. You tell me if this is better. Is that better?
A little bit, yeah. If you could just talk a little louder. I think it was the background noise.
Okay. Well, let me know if that's any
Oh,
better.
that's much better. Hello, you there?
Brian, can you hear me?
Perfect.
Yeah.
Yes, that's great. Thank you.
Okay. Sorry, okay, let's hope this continues to get better. Okay, so what I was getting to on this is that, the structures are all different, but again, you should know at least these three structures, because when you look at a company that is doing a concurrent raise, you want to know if the structures match, and they don't have to match, but the terms have to be the same, and you have to know how those structures work. So what do these companies have to do to get onto a crowdfunding platform? The first part is you have to have your legal create what's called a Form C. So this is the filing that gets filed with the SEC. It details the business, the team, the risks, everything about a company. And I'll come back to that Form C later. The second piece is a company has to produce their financials. And again, if you're doing the earlier 1.07 million regulation crowdfunding, they just have to be GAAP compiled. If you want to go up to 5 million, they have to be audited. And that means you have a higher level of vetting. And then the other thing that private deals don't have is every platform does their own level of vetting just to bring a company onto the platform. So if I want to put ArkHAUS on any given platform, that company is going to spend a few months reviewing everything we do, who we are, as if they were an investor. Because ultimately, they're putting their reputation on the line to basically say, this is a company that we believe in. We're going to put it on our site and we're going to offer it as a offering. And basically, one of the things that with a crowdfunding raise is that as a company goes through their raise process, they can't make changes in the background discreetly without you knowing. Any change that a company makes once the campaign has been launched, if it's a material change that affects you as the investor, they have to update the Form C. And that actually results in every single investor who has committed recommitting. What often happens with this is companies won't make changes because if they've, let's say, raised $500,000, when it goes to have all these investors recommit, they're going to lose a portion of that, whether it's 10, 20, or 30%. So every company says, okay, it's not worth it. You have to make some changes, right? Slight change to our business plan, that's not notable. But if I was to change my CFO in the middle of a deal, that's notable. We would have to note that on the Form C. So you have all these things that a crowdfunding company has to do and all these requirements that have to be met. Private deals don't have to meet these requirements. They can change their business plan. They can change their team. They don't have to have their financials vetted. They don't have to file anything with the SEC. And that's basically why I personally think crowdfunding is a better investment method for early stage investors. So what are the stages of these campaigns? Really, there's four. There's a few more, but four primary investors. Test the waters is actually an official stage, which is pre-launch. What a company does is put up a campaign page, not fully built out, let's say 50, 70% built out, has the relevant information, and they do some marketing to see who wants to go in and commit. It's a time for them to say, how much interest is there? Is there enough interest? Should we do this? Great. Is there too much interest? Maybe we should raise our valuation. That's another thing that can happen. And you'll see the terms can change up or down up until launch. But again, once they're launched and the Form C is filed, it's set. So then you get to launch. The launch has to happen within 2 hours of filing that Form C with the SEC. Up until the launch, all the investments are fully non-committal. Once you hit launch, they're soft commitments. You can cancel them. It's really kind of viewed as a no-no. You really want to commit to a company that you are investing in. And then as the deal goes, there's a pre-closing phase. So every platform's time period for this, what this pre-closing period is a little bit different. I believe on Republic, it's 48 hours before the official closing. When you hit the pre-closing phase, you cannot cancel your commitment. It becomes firm, it is non-cancelable. And then the deal closes and you move into post-closing. Then the company spends a few weeks managing all the document signings, closing on all the funds, and making the payout to the company. So just a few details you should be aware of if you're looking into crowdfunding as an investment. Fees, first and foremost. Now, the good news here is there are almost no fees. The credit card, the escrow, and the trust fees are almost always passed on to the company because they don't want to burden you as the investor with any of those fees. Nevertheless, I don't know every single platform out there, so you should always do your research to see what the fees are, and when they get taken out and how much they are. SPVs, this is a very, very big one for the company, but also for you as the investor. So when 1,000 people invest into a certain company, the question is, does that mean the company has 1,000 investors? Previously and historically, yes, that's what it meant. But what most companies do now is they pool all the investors into a single vehicle, an SPV, an escrow, or a trust, I'm sorry. And then that becomes one single entry into the cap table of the company. Now, that's relevant for the company, but the reason it's relevant for you as the investor is because if that company, if that platform does SPV, they work on your behalf as a proxy. If there are voting rights, or if there are any payments or anything that has to be done, that company is taking care of it for you, almost as if they are your broker dealer. And most of these guys are broker dealers, not all of them. So, and then the last thing they do is they manage any exits. So when a company has a material distribution, whether it's a periodic distribution or they sell and it's, they're exiting, the payout goes through the platform and then to you. And you should also check to see if there are any fees on that final payout. And I have not seen any on the major platforms, but always a good idea to keep that in mind. Okay, so here are a few other details to keep in mind. Every company has a campaign page. This tells you almost everything you need to know. This is going to tell you about the team, the opportunity, the market capitalization, their competition, their IP, and a variety of other things. What it's not going to tell you is some of the more detailed private information. Many of these platforms have a deal room. You can actually go in there and obtain the docs, whether it's the financial model or any contracts or agreements. But more often than not, they only make that deal room available to either accredited investors or by request only. So this next one is very, very important, which is why it has the only image on this picture, know thy meter. This is a meter I pulled from one of the campaigns. It claimed that they had 2,058,000 and change already invested and 8,000% of their minimum goal raised. And you look at that number and you say, no way in hell does that thing make sense. And you're right, it doesn't, but it kind of does. And this is a FOMO meter. What these companies do, what the platforms do, is they want to show that there is X amount of traction or a lot of traction. And yes, this company does have $2 million committed, but this 8,000% number is totally wrong. And that's because there are two minimums. The primary minimum should be what a company really needs from this round to build what they are trying to build. So let's say my company is raising right now, and we say we're raising 1.5 million. I really need at minimum $1 million of that to make this work. That should be the minimum, but it's not. When the company files the Form C, every company has to have a minimum. Apologies for the dog. Every company has to have a minimum and a maximum of how much they raise. And pretty much all the companies will set a minimum of 25,000 or sometimes 10,000 or 30,000. And it's in that very low ballpark. And this 8,000% is of that minimum. It's a total misnomer. You should never pay attention to this number because it's just creating FOMO and does not give you any real information. So moving on, we mentioned perks earlier. Some of these companies will offer what they actually offer to their customers as perks on top of your investment. And then a lot of them will offer cash flow projections, right? We have done X amount of revenue and we believe we're going to do X amount of revenue. make sure you know if this is actual, historical, or projected revenues. Take a detailed look at them, make sure you understand them, and make sure you agree with them. You might say it's 5% off, or you might say it's 80% off. 5% off, I would not go crazy about. 80% off, I'd say, I don't know if I believe in this company. A lot of investors will ask a founder to say, what's going to be my return on investment? You can't say it. SEC rules prevent anybody raising money from discussing a return or a projected return. You could talk about cash flow, but you can't talk about return on investment. So I can talk about what my company is going to do in terms of cash. I can't say how it will translate to you as an investor, because there's another million moving parts in the middle between those two. Definitely take a look at the team, make sure you believe that they can pull off what they are trying to do. And again, check to see if they're doing an external investment round and how that is shaping up. You know, if my company was at 0 on the external investment round and we had just started, you know, you're going to say, well, he just started. That's not a big thing. I'm going to commit $5,000. But if my company has been raising for 9 months and I still have 0 on my external investment round, that should, you know, raise a flag. And you should, don't say no to it, but reach out to the founder and say, what's going on with your external round? Is there something we don't know? Tell us more. So you want not only access to the deal, but you want access to these founders as well. But with crowdfunding, you're not investing 100,000 or 500,000. You're often investing 1,000 or 5,000 or 10,000, or sometimes even $100. You're generally not going to get a founder's time to sit down with you, answer questions for a $500 or a $1,000 investment. I would love to sit there with everybody, but we just don't have the time. We'll never build the company we're trying to build. What these platforms have done have created 2 areas where you can get all the information and get access to the founders. One is in the FAQs. A company will actually go in and, you know, preset a lot of answers to a lot of the major questions you're going to have. And then there's a discussion area where investors amongst themselves or with the company or with the founders can all have an open conversation. And the reason I, as a founder, will communicate in this forum readily is because everybody gets to see it. Right? If I answer a question once, 500 or 1,000 people all get the benefit of that answer. So I have an interest in answering everybody's question as fast as possible and as detailed as possible, because it just brings more information to the investors and gets more people to the deal. And that gets you access to the founders. So in the past 5 years, I would say a lot of people have told startups that venture capital doesn't like when they raise from crowdfunding and that they should not do so. And that is a myth. And there's 3 primary reasons that this is a myth. So the first idea is VCs don't like startups that have taken crowdfunding. That's actually true. And the reason it's true is because VCs don't like crowdfunding because it steals their opportunity to make those exceptional investments. That is 100% on point, because you now see VCs turning to crowdfunding to identify these companies and invest. When they see a company doing really well on a platform, they say, okay, that company has consumer demand. I see it, I'm going to jump in. And you now have VCs chasing what retail investors are doing. And that's the proof in the pudding right there. Next one, crowdfunding results in too many people on the cap table. True in some cases. The companies or the platforms that do not pool investors into an SPV, yes, that is a lot of entries into a cap table. The companies that do pool everyone into an SPV, that's one entry into the cap table. And in most cases, it will be the largest entry into the cap table. So it's actually even better. And the last one is crowdfunding is for startups that can't raise VC. That is wholeheartedly false. Companies that want to accelerate the raise, enable their customers to invest, evangelize their investors. A lot of consumer-focused companies will do this. And the last one is probably the one where I would put myself in that camp. We don't have time to play games with the investment round. You want to build a company, you want to do it quickly. You have to seize on that opportunity and make sure you're first to market. You can't sit there and play with, a handful of VCs not returning calls and taking their time. So you go get your consumer demand, you generate your crowdfunding raise, and then the VCs follow. And we're seeing that happen exactly to plan. So now getting over to you guys as the investors, how does crowdfunding play into what you do? This is a really nice merger of crowdfunding and SDIRAs because you guys get to use tax advantage dollars. And when you think about the upside potential of startup investing paired with tax advantage, it becomes kind of an explosive scenario. So if you're a cash investor or a Roth IRA investor, you are effectively using after-tax dollars to invest. So keep that in mind, is that a Roth IRA guy is similar to a cash guy, but there is an advantage to the Roth IRA, being that you can invest periodically and you're effectively dollar cost averaging your investment into startups. It doesn't have to be into a single startup, but it can be across a lot of them. You might say, I'm going to pick one startup every month and put in $5,000 or $1,000. And you're going to now get after-tax dollars, but your upside does not get taxed. And that's the beauty of that. Whereas a cash guy would. If you're in a traditional or SEP IRA, you're using pre-tax dollars to make investments. That means all the growth that you are going to have, you're not getting paid periodically. So it's not a compounding aspect. You're just going from here to here, and all that growth is, not taxed. And then the other reason the self-directed IRA is such a good match for crowdfunding is because crowdfunding or startups are generally a long-term investment. You're not going to get paid back in a year or in 2 years. You're generally going to get paid back in at earliest 3 or 4 year, but more likely in a 5 to 6 year period. And that long tenor means that you have a long period for your investment to compound over time in a tax-free manner. So that combination of early stage upside and self-directed IRA, the tax savings, that's a match made in heaven. A couple other things to note. Most of these platforms already accept self-directed IRAs. So you can, when you go to invest, you can say, I'm doing it as myself personally, via my RA, via my company, or a variety of other methods. You can be accredited or non-accredited to invest in these startups. And that's the beauty of it. If you make 40K a year and you want to invest, let's say $100 a month, you can do that. Doesn't matter. You're totally allowed to do that now. But if you're a larger investor and you want to invest $100,000 or a $200,000 check into a company that you really have conviction in, your platform can actually manage the verification process for you. So now I can't speak for NuView, but a lot of platforms will basically say, yes, we are the trust here. And yes, we can verify that Sam is accredited and can thus invest 100,000 or 200,000 into these deals. When you become a more regular or a more frequent investor, the platforms recognize you and they start telling you about deals and opportunities earlier. So if a company, let's say mine, is coming on board and you have no idea who we are, you might get a ping from the platform that says, ArkHAUS is launching a raise soon. Would you like to commit? And when you do, what a lot of deals will do is give a lower valuation to the first X dollars of investors. So in our deal, what we did, we said of the 1.5 million, $250,000 of investors, those first guys would get a lower valuation, and then it would go to our full valuation. So becoming a regular investor gives you access to early bird terms and deals. And then if you're a smaller investor or larger, you have the ability to distribute your investment amongst a bunch of deals and companies. You can actually on some of these platforms set an auto invest feature and say, I want to invest $1,000 a month. Here are the sectors I care about. And they will put in $100 or $500 or $1,000 on your behalf into each of these deals that fit your criteria. And that is beautiful because now you're taking very high upside type companies, you're distributing your investment, and you get the tax advantage benefits. So in effect, you are now becoming a mini VC yourself. And lastly, we talked about identifying a sector. So you guys, you have self-directed IRAs, which tells me you're already doing something right. Congratulations. This gives you the opportunity to work with these companies and become a value-add investor or a strategic investor. And if I was raising around and somebody came on and said, hey, Sam, I manage hospitality for X company. I'm investing $5,000. I'd love to help you out. I'm going to say yes to that every single time, right? Because if somebody who's an investor has an added incentive to help me out, just to help me out, you take that all day long. So if you can find a sector that you either care about or have expertise in and leverage that to help the company invest your own investment, that's the single biggest thing you can do. I'm going to do a little bit of analysis of these major platforms for you. So the two things I want to look at is, do these platforms accept self-directed IRA, and do they pool the investments into an SPV? So WeFunder, yes and yes, great platform. Republic, yes and yes. Start Engine, they do accept SDIRA, but they do not pool into SPV. What does that mean? It means a lot of the more premium companies and opportunities are not going to go there. And it also means that the company Start Engine cannot act on your behalf as a proxy, which means that company has to waste a lot of time communicating with 500 or 1,000 investors. Seed Invest, yes, they do accept self-directed IRA. The ability to pool into an SPV is optional, which is great because you can do whatever you want as the company. And now there's a wave coming out of self-hosted solutions. So instead of me as a company going to a platform and saying, I will do my deal on your platform, I can actually work with a company like Rialto Markets and host that crowdfunding on my own website. So now every platform is different, and we don't know what those platforms are going to do in terms of accepting IRA or pulling into SPV. But there's a pro and con there with working with self-hosted platforms. The con for you as an investor is that because it's self-hosted, that level of platform vetting is not there. So yes, they still have to file a Form C, they have to get their financials either compiled or audited, but they do not have to follow the platform's guidelines in every little detail. But the pro for the company is that double dip of marketing is actually almost quadruple now, because instead of me advertising to send dollars to a crowdfunding platform, I can send them directly to my website. So somebody who may come and be an investor will actually see what I'm selling, or a potential customer can come and see my investment. So while that's generally a benefit for the company, it is also a benefit for you as an investor, because that serves to improve the company on both sides, from their consumer offering as well as their investor offering. So how did we can get into all of this? One, I actually invested in my own company via SDIRA a long time ago. So I poked and researched and dug around and realized I could do it. So I literally pulled out my entire SDIRA and I put it onto my company. I would not advise people doing that, but I did. But I'm going to give you an example lead investor, and this is a real life scenario. So I have a friend named John Lee, who may possibly be on this call right now. And he's known what we're doing. And he basically reached out and said, hey, I'd love to commit, I know what you're doing. I think it's great. I want to commit 15K to your deal. And then he asked, can I use my SDIRA? I did a little bit of research. I went back to him and I said, yes, you can. And he said, okay, I'm going to upsize to 100K. So that's over a, it's over a 6x upsize. And you wonder, well, why would that happen? And that right there should tell you the power of crowdfunding for startups plus SDIRA and that tax advantage long-term benefit. John effectively became our second lead investor. We had another investor who had put in a similar amount. And basically that was now our third validation for our valuation. So we had the platform itself that said, yes, 50 million is great. We had one first investor, and then we had John, and they basically led it. Now, I mentioned earlier that we actually did a concurrent round, private and crowdfunding. What this allowed me to do is say, John, I'm going to actually have you invest over on the private side, and keep the other investor on the crowdfunding side, which provided a validation for both rounds concurrently at the same time, at the same terms. It was kind of beautiful. So, John, if you're on this call, thanks. Just a couple final thoughts on investing into startups and early stage companies using your SDIRA. We've already talked about the tremendous upside in tax savings. Be reticent of that and what it means for you every time you look at a deal. This is a newly available asset class to SDIRAs. It's less than 10 years old. It gives you an opportunity to diversify away from stocks, bonds, and other investments into a sector that you didn't previously have access to at the lower dollar amounts. With the lower dollar amounts, it actually allows you to diversify not only within the sector, but amongst companies within that sector as well. So that is a great idea. And then identify your sectors of interest or expertise. That's the ability for you to leverage who you are and what you know to help these companies. If you were going to invest in Coca-Cola, would you be able to go offer your legal services to Coca-Cola? Probably not. If you were going to invest in ArkHAUS and you said, Sam, I'm a lawyer specialized in hospitality, I'd take that call all day long. And then there's two things I very much believe in for an investor, even though I'm on the founder company side. I believe when you are an early investor, you're just getting in it, crowdfunding is a great place for you to learn. So you can learn by following and watching others and seeing which deals have traction, why, which ones don't, why did they succeed, why didn't they succeed? These are not super private, they're more public, so you get to see a lot of this information. But once you have learned by following, it's your time to lead, and you got to lead with conviction. One of the biggest problems in early stage investing is everybody has a follow mode. And I mean that angels, venture capital, everybody sits there and waits for the other person to pony up. And the people who actually have conviction, believe in the companies that they're going to invest in, and put down their money where their mouth is, those are the people that get in the earliest. They get the early bird terms. They sometimes become advisors for additional shares, and a lot of things go their way. And once you've had that chance to learn, you have a chance to lead with conviction and not only help others, but gain much more value for yourself as an investor. So, crowdfunding and early stage startups, it's a chance for you guys to go create generational wealth for yourself, for your founders, and hopefully not on just one company. When you exit, you do it again together and again together. And that's what these early stage investors and companies do. And this is your chance to do it as well. So with that, I'd like to thank you guys for taking that time to listen to everything I said. I hope that the audio was not as bad as we said it was, but thank you. Here's some contact information for me. I'll mention a couple of quick things. So ArkHAUS, we are actually going to go ahead and do a raise. And we did already do a raise on Republic. We had a lot of glitches, and we felt like our offering was very much got the short end of the stick because of those glitches, and they were larger than glitches, but we'll leave that for another day. So we didn't want to do this call without offering you guys the ability to invest. So you can go check out our website, arkhaus.miami. It's still very early stages. If you want to invest, go check out wefunder.com/ArkHAUS. And you'll see it's a very early stage campaign page, has our membership brochure, not a lot of details, but if we see some interest in there, we will go ahead and spruce it up and turn it on. And then I know a lot of you guys are in Florida. We host a lot of events down in Miami for ArkHAUS members and investors. Our next one's going to be in late July, early August. Just send me an email if you're interested in attending the next one. And then also we do a periodic investor call. It's a Zoom. I give everybody who's interested or already an investor the ability to learn more and basically invest or not invest, whatever they decide to do. So thanks again, Brian, Maggie and Grace. Thanks for having me on, and happy to answer your guys' questions.
Awesome. Thank you so much, Sam. I know I learned a lot. There's a few things that I had some questions about. If anyone else has questions like I do, we're going to start typing those in the Q&A section or the chat section. I'll read them off to Sam. So my first question, did you say you used your self-directed IRA and invested in your own company?
Yeah, I did. This was my first startup in 2008. So I had put away a good amount of savings, and I had also had my IRA, which was my company IRA. I actually moved it over to a self-directed, and then I took a loan against it and invested. So I was the first seed investor in my own company.
Okay. Yeah, and I've heard about people doing that, but as far as I know, that's prohibited. You're not supposed to invest in your own company. But I mean, there was other person that did, what was it, PayPal. He had a whole thing about how he used his Roth IRA as well to start up the company. So
Yeah.
I don't know a whole lot about that, but I definitely encourage anyone, do your due diligence before you do anything like that. If you're starting your own company or raising capital, speak with an attorney or tax advisor or
Yeah.
accountant, whoever
And
you
the
need.
rules may have changed there, by the way, but I mean, I did a lot of research on it, and I was allowed to at the time.
Okay. Yeah, they probably changed since then. I've been with NuView for 4 years. So since I've been here, that was a rule, but maybe back in 2000, you said eight. Yeah, I
Yeah.
don't know if it was a rule back then, but that was very interesting. That caught my attention. Um, so tell me a little bit more about the events that you do, like how are they structured and there are presentation involved.
Well, the investor calls will be very similar to this. We'll talk about everything the company is doing, everything we have to do, the hurdles we have to get over, and where we are at on each of those challenges. It's actually really, really interesting to kind of hear some of the back end nitty gritty of what happens with the company. So even if you just want to listen in, feel free to send us a message. The events we do in Miami, they kind of ride the line a little bit. So the first one we did was an investor dinner. We literally took out 15 investors to dinner at our favorite restaurant in Miami called Doya. And then we've done a couple other, more consumer events where our ArkHAUS is a membership base of 360 members, and we're already about a third of the way into that membership pre-sale. Luckily for us, we haven't done much marketing, but people are really taking to it. So we basically invite our member applicants to come hang out. We'll throw some kind of a party. The next one might be like a mini concert of sorts. Pretty well-known DJ in Miami, really cool scene. Drinks, hang out, maybe a small talk, something like that.
Okay.
But that'll happen late July, early August.
Nice. Okay. Yeah, that sounds pretty interesting. I mean, other than ArkHAUS, any other campaigns you've worked on in the past?
Um, I've done a couple of product crowdfunding offerings for my other company. I also run a retail technology startup, which has now kind of, we don't raise for that anymore, not at the moment at least. But we also did do one crowdfunding campaign for that. I want to say it was around 2016, if I'm correct. We raised a few $100,000, and that's what got that company off and running. So that was great. Crowdfunding was still very, very new then. So we were kind of very early in pulling the trigger on it.
Yeah. So right now, I mean, my phone's been blowing up. People are trying to get their money out of the stock market with all the current events going on. A lot of people are losing money. Even cryptos are starting to tank. So how would you compare those types of traditional investments to something like crowdfunding?
Well, I mean, I think crowdfunding, the first thing is, early stage companies, very small, very early. Most investors will view early stage investing as zero or hero. It's binary, right? You're going to put in X amount of dollars and you have to be willing to part with that and put it away. It's not like a stock or a bond where you're going to lose 5%, 10%, or make 10 or 20%. Most often than not, these companies are either going to move to the next stage, raise their next round and grow, and you're going to your valuations basically spike 5x or 10x on each capital round. So the entire company and thus your investment is scaling on an exponential level with every deal round. But you also have the opportunity to go to zero, and if out of 10 companies, probably 6 or 7 of them go to zero, 1 maybe 2 of them raise a couple more rounds, and those are your 10x, 50x, 100x scenarios. And then you have the occasional ones in the middle that kind of either get to a place where they find kind of like a stability area and they say, hey, this is the business we're now able to build. So it kind of becomes a normal business, not a huge upside business. But in some cases, you'll get a founder that'll say, let's say we raised $2 million, we spent $500,000 on it, and we got to a point where we realized we just cannot do this. There's some major block. We're going to take the $1.5 million and give it back. And that'll go back to the investors pro rata. But that's not common. So what you really have to treat this market is that it's binary on huge upside or downside. And, crypto seems to have some of that. I would say I personally don't believe crypto is going to zero. So you don't have the zero scenario, but you also, I don't think you have the 50, 100x scenario unless you're outside of Bitcoin and Ethereum.
Yeah, good points there. I don't see that there's any questions, but my other question for you would be, if somebody was looking at crowdfunding, what's some due diligence that they can do to be proactive and, kind of figure out if it's a good investment? I mean, a lot of these like startup tech companies, there's so many things out there. There's apps, there's real estate, there's a lot going on, but like, what do you suggest somebody does to start doing due diligence?
The first thing is I would jump on a couple of the major platforms and just review as many deals. Look at the deals that are getting a lot of traction and look to see why that is. What's the unifying theme across those deals? And what are the deals that are getting less traction? What's the unifying theme there? Now, that doesn't mean that the companies with more traction are going to do better. But what it does tell you is what the rest of the investor base or the existing crowdfunding community looks for and looks at. So that's what I would do. And then, this is your opportunity to get a really in-depth look at an early stage company. Unless you were previously investing $100,000 plus, you wouldn't get that look. And now you're going to get detailed information that a founder would never reveal. So pick and choose a few sectors, focus in, find a couple of deals, really dig in and find out what are their primary obstacles? Are they past them? What's the chances of passing those obstacles? And, basically you have to make a judgment call on, is that founding team going to be able to pull that off? And the last thing I should have mentioned this and put a little bit more emphasis on this is founding team is more important at early stage companies than any other type of company. You take a blue chip company like Coca-Cola, you could get rid of half of their executive team, they'd hire new people and they would be just fine. Early stage, you have to have the exact right people in place. And it is very hard to hire for early stage. So you got to make sure that people that are in place are the guys that you trust to execute on that.
Yeah, I like that. Definitely. I think building relationships with whoever it is you're investing with is important. Asking the right questions. Maybe I could bring you back and we, maybe you can present a checklist or something that people should ask maybe before they do invest. But Sam, I appreciate you coming out, taking some of the time out of your busy schedule to present to our clients and our viewers. I know they took some value. We got some feedback. Some people in the chat in the Q&A said this was a great presentation. They loved it. They got a lot of value out of it. So thanks again. And I will be touching base with you afterwards. Once again, if you want to reach out to Sam, we had his contact info on the screen. Feel free to reach out anytime. If you have questions on self-directed IRAs, you can reach out to myself or my team. You can reach us at IRA specialist at NuViewTrust.com. That's IRA specialist with an S at NuViewTrust.com. Also, if you want to stay up to date with anything we're doing on social media, you can follow us on Facebook, YouTube, LinkedIn. Scan that QR code and you will definitely be up to date with everything going on at NuView. So we're going to wrap it up. We'll see you guys next Wednesday at 1 p.m. Thanks again, Sam. Have a wonderful rest of your day.
Thanks, Brian. Thanks, guys.